natural gas or gasoline, Brent Crude, WTI Crude or heating oil? How do you decide on the optimal energy holding for your portfolio? And once you've settled on the appropriate allocation, how do you know which energy company is the right one to pick? To help with your decision making, we've created this short video.
Oil is a volatile commodity often evidenced by a whipsawing of investor sentiment from massively bullish as oil rallies to bearish following oil price declines. Rolling back the calendar to 2008, when oil soared to $140 per barrel, energy producers began investing in technology and research, looking for additional ways to unearth energy commodities. These technologies allowed companies to more efficiently extract oil and liquid natural gas from shale land basins, a process known as fracking.
Long-term fundamentals for natural gas are bullish, and domestic production is expected to rebound this year. Much of this is due to the growing use of liquefied natural gas, increased exports to Mexico, replacing coal-fired power plants, higher demand from industrial projects.
Even with all this energy information at hand, picking the right company in which to invest can still pose problems for investors. Luckily, the guesswork has been taken out of the equation since you can buy energy products in a single exchange-traded fund or ETF commodity basket.
ETFs can be a simple and efficient way to introduce your portfolio to commodities and can be a low-cost alternative to direct investing in this asset class.
Keeping in mind that for tax purposes, many commodity funds are classified as limited partnerships by the IRS. It's important to know this because these funds have complex tax implications and generate Schedule K-1 forms. Since this paperwork can create an inconvenience and frustration for investors, be sure to look for commodity ETFs that are free of K-1 forms.
Finally, as you consider which ETF to purchase, here's a key point to keep in mind. Most individuals who invest in commodities don't want to take possession of the commodity in which they've invested. After all, finding space in your basement for those 1,000 barrels of Brent crude could pose a logistical problem. Institutional investors know this and carefully monitor monthly maturity dates. This enables them to front-run individual investors, snapping up shares on the open market before you have a chance to sell yours. The result is the possibility of diminished returns.
The potential solution is to invest in a commodity fund with a longer dated strategy. Doing so avoids the institutional traffic, who mostly focus on standard monthly contracts. This could potentially result in a more positive experience, greater liquidity, and the potential of improved returns.
An important disclosure follows. An investor should consider the investment objectives, risks, charges, and expenses of the ETFs carefully before investing. To obtain a prospectus containing this and other important information, call 1-646-846-3130 or 844-ETFS-BUY or visit www.etfsecurities.com. Read the prospectus carefully before investing.